Debt coverage ratio is the net operating income divided by the debt service. It's a measure of margin of safety for the lender in assuring that the money will be available to service the loan. So whenever the NOI or net operating income is greater than the debt service, your debt coverage ratio will be greater than 1. Typically, lenders like to see a number like 1.2 or higher when you start a property. Now, there are two factors here. One is the debt service and the other one is the net operating income. The net operating income takes into account the total gross income minus any vacancy or credit loss. That gives you the effective minus any expenses. And here we're looking at just the first year. Now, what is the first year? This is the APOD, which takes the first month and then multiplies it times 12 to create a year, assuming no changes. So if we click on Show Monthly, here we have the net operating income for 1 month and the debt service for 1 month. If we multiply those times 12, that's how we get to the APOD. So we'll go back to the APOD. This means that it doesn't assume any changes over the first year. It assumes whatever is there the first month, like a snapshot, is there for the entire year. In this property, we're going to click on Exit to the bottom right and go to the Report Income Statements and take a look at the first year on a monthly basis. And here we can see we have the net operating income, and it changes during the year because we have some vacancies. But notice that the debt service stays the same all the way through. Now, let's go back to yearly and go to the annual statements, which is a different report that's like the APOD, except this one takes the full 12 months into account, and you'll see the net operating income is different than the was in the APOD, and because of that, our debt coverage ratio is a little bit lower. So, which one is more accurate? Well, probably neither is accurate. One assumes that the tenant's going to leave for 6 months and then has a new tenant come in at a higher market rate. Is that going to happen? Well, that's a projection. Also, the APOD assumes he's going to stay the whole time at the same rate. So you have to kind of decide when you're looking at it, take these things into account. Now let's click on Exit and go to Sensitivity. When you're in sensitivity, you can vary things against the debt coverage ratio. Why don't we vary the interest rate on the loan and see how that affects the debt coverage ratio. We'll vary that from 7 to 8 in steps of 0.25 and click on Run. And we can see that currently we assumed it was 8. So if we have a lower interest rate, that means we're going to have less debt service, which means we're going to have more ability to pay that debt service with the same NOI. So our debt coverage ratio increases. There's more safety for the lender. Let's click Another. Now let's vary something that happens with the NOI. Here we'll vary the general vacancy and credit loss. We'll vary it from starting at 0, stopping at 5 in steps of 0.5. And when we do that, we can see how that affects the debt coverage ratio. Of course, the more vacancy there is, the less income there is, the less ability there is to pay back the debt service. In this ratio, the debt service is staying the same. We're just lowering the amount of net operating income to pay back that debt service. Now if we click on Exit, we can also go back to the Report Income Statements and look at the debt coverage ratio over time. Now as we go through each year, it's only taking the current net operating income of that year and the debt service of that year to show you the debt coverage ratio. So what this is showing you is over time how the debt coverage ratio is looking. If we click on Graph, we can actually view this and you can see, let's change to make sure we're looking at the debt coverage ratio. We can see that we have more ability, there's more safety for the lender as we go out. But in 2015 it goes down a little bit, but at this point we're still well above the 1.2. We're showing 1.5. That's very good. Lots of safety for the lender at that point. So this is the kind of debt coverage ratio graph you'd like to see. We'll go back to report. And so the advantage of the ratio here is that it's taking each individual year. It's not assuming anything before it or after it, and it's a very limited scope. So that's what it's telling you. We're going to click on Exit to get back to the Assumption Edit screen.